Hello and welcome to Star USA Training. Today is Tuesday, December 14th, and we're going to be talking about restricted party screening. We are recording the webinar. The slides in the recording and any other materials will be made available after the broadcast. With this one in particular, there are several supplemental materials that I would recommend that you pull from our website. We'll send that link out later on this week. Everyone's going to be muted during the session, but if you have questions, please make use of the webinar software and we'll make sure that those get answered at the end of the session. And lastly, this session is available for 1 CCS credit. So if you have your NCBFAA ID number, send that over to us after the session. There'll be a little form that pops up on your web browser to help you do that. Before we get started, my name is Mike Easton. I am the President and General Manager of Star USA Inc. We are a trade and compliance consulting advice, training and services company based out of Northeast Ohio. We provide internet source trade operations, support for audit and disclosure, help with determining HTS origin values, managing your CTPAT program, and again, providing training in all areas of trade and compliance. So if you have any international trade compliance needs or information that you would like to gain, please reach out to us. We'd be happy to help. Okay, so today we're talking about restricted party screening. And the goal for today's session is to provide you with an understanding of the regulatory environment and to provide you some of the knowledge on the building blocks that are needed to create and maintain a program that works for your situation. Restricted party screening is not one size fits all. It encompasses a broad array of disciplines. And I don't think that people are always aware of the amount of moving pieces that are involved with the concept of restricted party screening. So my job today is really giving you the knowledge and some of those resources to point you in the right direction, but I will not be solving the problems and the challenges that you might have. Those of you that submitted questions prior to the session today, I do have a slide at the end where I will address all of those, and hopefully most of your questions will be addressed during the slides themselves. So first up is the regulatory environment. And we're going to be talking about the agencies, directives, resources, and penalties associated with the concepts behind restricted party screening. When we talk about RPS, and some people call it denied party screening or various other acronyms and names, we're really focusing on controls that are implemented by 3 primary agencies. The first is the Bureau of Industry and Security, which is part of the U.S. Department of Commerce, and their regulations are codified under Title 15 of the Code of Federal Regulations, Title 15 CFR, and they deal with a lot of the dual use technologies. Another one of the primary concern is the Directorate of Defense Trade Controls, the DDTC. They're part of the Department of State, and their regulations are controlled within Title 22 CFR. And they are dealing mostly with military technologies, defense services, United States munitions lists, things of that nature. And lastly, we'll be talking about the Office of Foreign Assets Control, OFAC. This is part of the Department of Treasury, and most of their regulations are codified under Title 31 of the CFR. I'd love to go into a lot of depth about all these things, but really we're just going to hit the primary directives that are in place to help us understand what we're faced with and why we're faced with them. So first up are some of the denial orders that are published in 15 CFR 736.2. In particular, we have General Prohibition 4. You may not take any action that is prohibited by a denial order. These orders prohibit many actions in addition to direct exports by the denied person. So we're talking about beyond just the actual act of exporting, many actions in addition to direct exports, indirect exports, deemed exports, release of controlled technologies. We'll talk about those in a second. Effectively, you are responsible for ensuring that any of your transactions do not violate the terms of the order. I'll come back to that in a second. General Prohibition 5 discusses the end use and end user prohibitions. You may not, without a license, knowingly export or re-export any item subject to the EAR to an end user or end use that is prohibited by Part 744 of the Export Administration Regulations. When we talk about these denial orders, these prohibitions, you'll notice that they do not say in order to prevent these things, you must do X or Y or Z. They do not say that you must conduct restricted party screening. They say that you are responsible for ensuring that your transactions do not violate the terms of the order. And that is a very broad directive, but it helps to understand that they don't care what you did or did not do. You just may not violate the terms of the order. Whatever your processes are, do not violate the order. So in some cases, in fact, in many cases, many companies get by just fine doing nothing, and they are still not in violation of the orders. So it's important to understand the scope. Many companies that do not take minimum steps or perform the due diligence are instead held to a very high degree of accountability if a violation does occur. So it's about knowing where your risk vectors are. I want to clarify some possible confusion over what is considered an export. Under the Export Administration Regulations, an export is defined as any item in U.S. trade, including goods, technology, or information. It includes U.S. items wherever they may be located, even if they've already been exported. If they end up in the hands of a denied party or a restricted party, or going to a place where a license is required and no license has been obtained, that is a violation. In addition, we have deemed exports. A deemed export is the release of any control technology, software, or information to a non-US citizen. That non-US citizen can be in the US at the time of that release, and that is still prohibited. That is considered a deemed export to that individual's home country. The release, the word release means basically giving any sort of level of insight or information, and it can occur from something as simple as providing a facility tour to a prospective buyer. Somebody's visiting from the UAE and they want to see your operations before they enter into a large contract with you. Providing them a tour of your facility, if there's control technology in there, that constitutes a release of that control technology to that foreign individual. Or if that individual happens to be a debarred party, that also constitutes a violation. Allowing someone to inspect diagrams or schematics, providing someone instructions on how to use control technologies or items, giving presentations. This presentation is considered an export to the home countries of my entire audience. Now, I don't have any control technology in this presentation, so I'm not in violation of any orders, but it's one of those things to be aware of, depending on what kind of information is in the materials that you're presenting, that constitutes an export. And sharing source code. This is one that has tripped up a lot of people in the technology sector when source code is available on servers that is accessible outside of the US. So what's not an export? Items in the public domain, and then artistic or non-technical publications like maps, children's books, and sheet music. Effectively, any communication, any provision of physical materials, any disclosure of any kind, that counts as an export. And it doesn't matter where it occurs if it is concerning US technologies. In addition to those the export governance, we also have the Office of Foreign Assets Control, Sanctions, and Embargo programs. The OFAC, as part of the Department of Treasury, is primarily concerned with the transfer of money, either coming into the US or leaving the US, or US persons. It has to do with how banks transfer funds, but it impacts US businesses quite directly because you're the ones conducting the business. And if you are receiving funds from, or if you are paying money to a debarred party or conducting business with a restricted sector, a particular country or region that is restricted, you are in violation of the OFAC embargo programs. As part of its enforcement efforts, OFAC publishes a list of individuals and companies that are owned or controlled by or acting for or on behalf of targeted countries. This is one of the key components of that restricted party screening activity. Their assets are blocked, and US persons are generally prohibited from dealing with those parties that are published on the specially designated nationals list. On the right-hand side, we have some countries or regions of particular interest or concern, with the caveat that this is not an authoritative or comprehensive list, and it's not indicative of any specific sanctions or embargoes. A lot of the sanctions and embargoes that are in place on specific sectors within those countries. Whether those sectors can be geographic, they can be based on industry, they can be based on certain types of transactions or how they're conducted. So it's important to be aware that the nuances in the variables that influence how and why certain places or parties are on these lists is not as simple as recognizing, hey, this person has an office in Lebanon, therefore they are prohibited from doing business. It's more nuanced than that. And it's important to understand that if you're going to do business with a party that is in Lebanon, you need to conduct enough due diligence to satisfy that you have met the terms of those denial orders, where you have not conducted business with one of those debarred parties, that you have not violated one of those orders. And that's your standard. Do not violate those orders. The government puts out lots of official guidance, and I have several links here. Again, you'll get these slides and you'll have access to these materials following today's session. But these are published by the government, and they are considered either authoritative or instructional in how you conduct your programs and how you create the policies and procedures that you follow within your organization. They're meant to help you not violate those orders. They are not a roadmap or a game plan on exactly what to do so that you do not violate those orders. They are starting points and they are building blocks. And it's important to have awareness of what these are and how they're used. The consolidated screening list, we'll take a look at that a little bit later on, the BIS tool that they give you. The red flag indicators, the know your customer guidance, and the warning indicators for trade-based money laundering and terrorist financing are good starting points for education, training, and awareness within your organization. The don't let this happen to you guidance is extremely helpful for putting the regulations, the violations into real terms, looking at exactly what can happen in the event that something goes wrong. BIS Form 711 helps with that end user and end use prohibition by obtaining statements from your buyers on who the actual end user is and what their actual end use is going to be. And then the license applications that you may need to obtain in order to conduct business lawfully with those parties. Somebody did ask for a reference to the violations and penalties that exist within this universe, and we're mostly focusing on EAR, ITAR, and OFAC penalties. We have civil penalties for EAR and ITAR on this slide here, which includes any violation of export controls or sanctions, $10,000. This is all documented under 50 U.S.C. Chapter 56. If there is a national security or defense related component to this violation, the penalty escalates directly up to $100,000. Plus, you have your potential loss of export privileges. You can be debarred or denied from being able to export your products ever again, or to specific countries, or under various circumstances. So there are some additional caveats that go along with the monetary penalties, particularly when it comes to these export controls regulations. Willful violations escalate the penalty universe. Generally, this is any knowing violation or conspiracy to violate or attempt to violate any export control provision. And you're looking at starting at 5 times the value or $50,000, whichever is greater, plus up to 5 years in prison or both per violation. And these can escalate, particularly if you have systemic instances of violating orders, particularly if they're willful. Those counts can increase dramatically. If you do any of those violations, those willful violations, with the knowledge that the export will be used for the benefit of, or that the destination is a controlled country or any country to which exports are controlled, then you have $1 million or 5 times the value of the transaction, plus up to 10 years in prison. And if you have a failure to report a valid licensed export, if there is knowledge that the export will be used for military or intelligence gathering purposes contrary to the conditions of the license, you have a $1 million or 5 times the value fine, or $250,000 plus up to 5 years in prison for individuals per violation. And many of these export control violations can indeed pierce the corporate veil. Individuals can be held directly liable, particularly in the criminal cases where there are willful violations. So it's important to recognize that the actions that you do and do not take can come back to haunt you. And ensuring that you've got the right levels of accountability in your organization is one of the best ways to ensure that you've got the protections that you need, that you've mitigated those risks, and that you're conducting your business correctly and fairly. In the OFAC universe, we've moved into 50 USC chapter 35. We have the civil penalties, which is any violation of the export sanctions or attempt or conspiracy to violate, or for causing a violation to occur. And again, as we get into these ORs, the liability vector kind of broadens. So knowing what you're doing and why you're doing it, and how it's being done, and how all those things tie together is an important piece of maintaining that compliance. And you're looking at a $250,000 or twice the value, whichever is greater, for a civil case of a violation of an export sanction. And examples of that would be allowing goods to be shipped to Iran, allowing goods, or attempting to violate or get around those sanctions to allow those things to happen. You're looking at $250,000 for that. If you get into criminal, which is any willful commission or attempt or conspiracy to commit or aiding and abetting the commission of one of those violations of the export sanctions, you're starting at $1 million for each violation, plus up to 20 years in prison or both. Very severe penalties. OFAC, again, is the primary one of the primary agencies that you're going to be dealing with when you're considering restricted party screening, and understanding what the cost of violation is in this context is extremely important to ensuring that you've got the right support in place from all levels of your organization. Okay, so that's the scary part. We're going to move into some of the methods and practices. It's important to remember when creating a program or when executing your program that your objective is demonstrating compliance through sound policies, defensible procedures, and comprehensive documentation. You're trying to prevent the violation of one of those prohibitions or those denial orders that we talked about earlier. If you have all of the practices and protocols in place, that is going towards your due diligence threshold. If you have none in place, then you are clearly not adhering to due diligence, and you cannot demonstrate your compliance, and therefore you're going to be considered to be at least non-compliant and in violation of the civil penalties, regardless of the circumstances, if you don't have those controls. And at most, if you had reason to know, or you should have known, you could be found or you could be penalized under the criminal cases or the willful violations because you took actions or you actively did not take necessary actions to prevent the violation of those orders. It's important for every organization to have a system of checks and balances in place in order to meet the goals that we're setting out here. One of the first elements to that system is a culture of awareness throughout the organization. You need to understand the requirements that are on you as an exporter, or as a company that does business internationally, or a company that hires international employees, or a company that has affiliates overseas. Understand what your requirements are going to be in those different scenarios, and understand what steps you need to take. This includes avoiding the blind eye traps and the reason to know standards. Turning a blind eye can happen in 1,000 different ways. And most commonly, what we're talking about here is ignoring a red flag or neglecting to take an appropriate action. That's what we mean by turning a blind eye. Not being aware of a violation is not a very good defense if a violation were to occur. Again, your requirement is that you do not violate those orders. It doesn't matter if you didn't know that you were violating it. If it's violated, you are in non-compliance and you are facing penalties. As an exporter, you're going to have reason to know what's happening with your shipments. You're going to have an expectation of taking those minimum steps to ensure that you're not violating those orders. And additionally, the government provides you resources to help you ensure that you're not in violation of those orders. And it's important to share that knowledge with all of your key stakeholders. We'll talk about that, who those key stakeholders might be on the next slide. So once you have your cultural awareness, it's important to take your proper steps to conduct your authorizations, your verifications. Take the steps to identify the actual risks that are in place for your type of business, or the transactions that you're entering into, or the nature of the products that you're producing, or what regions you're selling into, and obtain all the necessary information in order to make an informed decision. It's on you as the controlling party, as the US party, to obtain whatever information you need in order to prevent those violations. And lastly, ensure that there's an authorization in place, someone with knowledge of the facts that has the authority to issue a stop order on any suspected transaction. In the parlance of the ITAR, this is going to be your empowered official. And this person has the authority, responsibility, and the knowledge to prevent violations from occurring. When I say authority, I mean that they can actually prevent the transaction from going forward, regardless of what the CEO says. And this person has to have the ability to do that. When we're talking about awareness, training, and education, your primary focus within your organization should be around the red flags and warning indicators. Make sure people are informed on what sort of things contribute to a problematic transaction. They need to know who to notify and when they need to bring that person into the loop. Provide guidance on what to do and what not to do. In many cases, the what not to do is as important as the what to do. And knowing how transactions come in, how an order might come into your shop, and who's the first person to process it, and what their initial red flags might be. And imagine the chain of custody for any given order, how it flows through your business. An order can come through something as ambiguous as a website form, and people submit an order, and it goes to your internal systems, and it triggers your production. And if there's no human intervention in that chain of custody, it's almost impossible to identify those red flags and those warning indicators. And you don't have that level of attention to the actual fundamentals, the nature of your transaction. And you need to institute additional checks and balances into that process. And you also need to not proceed with performing an order just because the computer system told you that it's due for production and shipment. Instruct people, provide guidance on how to ask questions and how to obtain information, whether it's questions from internal resources in like a trade compliance field or legal, or whether they're talking directly to buyers or interested parties. Instruct them on how to get the information they need in order to maintain or at least satisfy the due diligence requirements of these export controls and export compliance requirements. Also, teach people how to document events and their correspondence. Correspondence is a big deal when it comes to mitigating factors, or actually, in most cases, correspondence is a big deal when it comes to aggravating factors. What people say in their communications, both over email or even on the phone, can go a long ways in determining how complicit they were. And it might be the difference between a civil penalty and a criminal penalty if people are not taking the appropriate precautions when dealing with foreign parties. And then also teach people where and how to retain the records. This is going to be, again, based on your business, what practices you have, what tools you have available to you, but you need to retain your records, and people need to know how to do that appropriately. It's not as simple as just saying, keep your records. And I'm using air quotes here, nobody can see that, but you have to give people the guidance that they need so that they are, so that you can be confident that they have kept the right information in the right place so that it can be retrieved. Inability to retrieve documents and records is as effective as not having them in the first place. So who all needs to be aware within your organization of these different red flags, of the warning indicators of what these instructions are? And I take a pretty broad brush on this stuff, but I think a lot of people neglect to recognize the role that these teams, that these departments play in international orders. We've got sales, obviously, they're the ones that are usually on the front lines trying to obtain business with foreign parties. You've also got procurement. Buying goods from denied parties is just as much a violation as selling goods to a denied party. Your customer service people, who tend to be the ones that are interacting with the customers the most, they're going to have the most insight and information to how that customer is set up, or who's involved in this transaction, or what the nature of the purchase is going to be. Make sure that they're aware of those things. You might have a separate order entry team that is really just processing orders, but if they're not aware of what red flags to look for, what warning indicators are out there, they may not catch a problem that they otherwise could have and should have. Your financial team, this one is the most commonly overlooked, and it's actually one of primary vectors, I think because it's often overlooked, of violations. People receiving money from a denied party or restricted party is a violation. If you get paid by a customer, let's say you fulfilled an order and you shipped it out, and all the parties on that shipment and placing the order were not restricted in any way whatsoever. You did your screening, you found the answers that you needed, and you end up receiving payment from a bank that's on that restricted entity list. I don't know of any companies that conduct screening on the people that are signing the checks. And that has been a problem for at least one of my clients, where they were found to be in violation because they had received money from a denied party, and the actual financial institution was the denied party. Your logistics teams, your executive teams, people are often scared to tell the CEO or the CFO or the CTO about the risks that are inherent to doing business. And a lot of times, many executives don't want to hear it. They don't want to hear about the obstacles, but they need to be informed. They need to be aware. And somebody has to really have the responsibility of communicating what is being done. They don't want to hear, in my experience, they don't want to hear what the problem is. They want to hear what steps are being taken and whether those steps meet the threshold of compliance, or at least help protect the company from unnecessary risks. Obviously, your trade compliance teams, we tend to be the ones in the trenches dealing with all of the questions and challenges, but don't neglect your engineering teams. A lot of times they'll be working with parties overseas, sharing schematics and drawings and working towards a certain goal, even if it's at a customer's request and there's a spec order and the customer's involved in the actual schematics and blueprint process. Those communications are part of your deemed exports universe. Your foreign affiliates, this goes for sister companies or joint ventures or other relationships that you have with companies overseas. This can oftentimes be problematic because we are talking about in the world of exports, U.S. goods wherever located. If your company is the owner of the goods, or these goods are considered to be U.S. goods under the purview of the government, the U.S. government, these export control restrictions, these restricted party screening requirements, apply to those transactions, even if no U.S. person is directly involved in the actual transaction. If it's U.S. technology, if it's U.S. goods, that still makes it under the purview of the U.S. regulations. And lastly, your supply chain partners, communications with your forwarders, your brokers, the steamship lines, whoever you're dealing with, making sure that they are aware of things to look out for, when to advise you of things like a diversion in the transit of the goods. That's happening a lot right now with things like COVID having supply chain disruptions around the world, things like the Suez Canal being backed up, the port strikes, fires. All of these things are causing disruptions to the supply chain, and ensuring that your supply chain partners are communicating with you when changes occur to allow you to conduct additional screenings or evaluate the circumstances a little bit more deeply than you would have otherwise, because they notified you in a timely manner. Hopefully that gives you a kind of baseline of how these things touch in with those different departments. If you're ever needing more insight on how to communicate with these different partners, feel free to reach out. We'd be happy to give you some of our real life examples of what we've done to bring people into the fold so that they understand what's going on and why it's going on. Okay, so the BIS publishes a consolidated screening list, the CSL, and they provide a online search tool for making use of it. This is a free search tool. It screens against 13 lists that are provided by the BIS, the DDTC, and OFAC. And you can find more about those lists at the links below and some of the previous links before. You can also download the consolidated screening list for integration directly into your internal systems, or you can interface directly with it via automated programming interface, an API. There's ways to leverage the information. It's published, it's made available by the government. And this is one of the reasons why not knowing is not a defense. I didn't know I was transacting business with a denied party. Well, we've given you the tools. Why haven't you used them? The BIS CSL search tool is not the most robust version of this. There are other tools that can be purchased by from third parties. Those third-party tools can also integrate lists from the EU or from other countries and other regions around the world, in addition to the US list. And that might be relevant to your organization. Obviously, the US government is not going to be publishing lists from other countries. I do find that the consolidated screen list search tool on the BIS website is pretty effective. It takes some knowledge on how to input information and what information you're inputting. There are several different, I had gone through several different varieties of doing some demos on how to use this effectively. And the reality is that dropping a name into the box and hitting search isn't enough. You need to be a little bit more flexible in how you're conducting your checks. You need to drop off the LTD or the CO or the company, the abbreviations, the SA to CV for Mexican companies, the GmbH from German companies, things like that. Drop those off of the company names that you're searching on or the individual's names. Turn your fuzzy name searches on. And a lot of times addresses can be formatted in many different ways. And you do not want to be searching on a literal specific full address, because a lot of times it's not going to be captured quite the same exactly. So that fuzzy search being on allows you to capture different variants, but also shorten the address. Don't put all the parameters in there so that you're ensuring that you're casting the right net. When you conduct your screenings using this tool or any other tool, make sure that you're documenting what exactly was screened upon. If you searched on 4 different variations of the company's name or the individual's name, or 8 different variations of or combinations of the address, make sure that you're capturing and documenting all of those things. This will help ensure that you're actually covering your bases, and it will also help you recreate the chain of events that led to a violation should one occur in the future. When you get hits on these lists, you're not done. A hit does not necessarily mean that this is a restricted transaction, and it does not mean that it's a safe transaction. It means that more information is required. And as you conduct your additional research, and we'll talk about the 50% rule in a minute, as you conduct your additional research, you need to recognize whether or not how far you need to go in vetting this company or this individual for the purposes of this transaction. A lot of times I will give guidance to companies that if they have red flags or enough suspicion of a particular client and the transaction is a relatively small amount of money, it's $10,000 or something like that, maybe it's not worth doing business in that instance. Forego that sale in order to prevent the possible violation. Again, your requirement is that you do not violate those orders. The requirement is not that you conduct thorough screening. The requirement is do not violate the prohibitions. So it doesn't matter how good your screening is. If you still violate the prohibitions, you're going to be in violation of those orders. When it comes to quantifying engaging the risk that you want to take on, if you've got a $30 million sale, it's worth doing the extra due diligence. Go through all of the motions, get additional insight, even consult with some of the agencies if you have suspicions. Recognizing where those balances lie for your organization is an important piece of not taking on unnecessary risk. Generally speaking, when using the CSL search tool, it is sufficient to simply type in the name and turn fuzzy searching on, and then hit search. It will default search all of the lists. It will default search all of the countries. So that is enough of a interaction for getting a pretty broad net. And you want to make sure that you're, again, manipulating that company name. You can add in things like the address to narrow down. You can add in additional parameters or search on different variables and different people that are part of the transaction. But from a simple level, you can put in the name and turn on fuzzy search and go and see what you get from there. And I can give a lot of examples on how to use that tool. I'm not going to do it today. Are we doing in time? We're doing okay. The progression flow, generally speaking, these are the steps to the checks and balances that I think should be in place. You want to make sure that you've identified all the parties to the transaction, provided them the informed guidance that they need in order to execute their responsibilities successfully, and ensure that they are alert to the red flags and warning indicators. Once you've got those checks and balances in place in the right spots in your organization, you need to conduct those verifications. Perform your restricted party screenings using at least the consolidated screenings list tool. You want to be screening individuals, entities, owners, and any other interested parties. And you want to periodically rescreen. We'll talk about that again a little bit later on. But you want to conduct those verifications. And as you're doing that, you're going to identify that you're missing certain information or that you need more information to know or have a complete picture. So you want to make sure that you've gone back to the customers or talked more in depth with your sales or customer service teams. Get the clarification that you need from the customer or the suppliers as needed in order to satisfy the due diligence that you need to have in place based on your risk level and your business type. You also need to retain your records, ensuring all the appropriate records, including your communications, are saved and retrievable. And you want to tie your records to specific transactions using smart record keeping practices. It's kind of ambiguous how that's phrased, but what we're saying here is that if the BIS or the OFAC are going to identify a specific event, and it's not necessarily going to be tied to the same numbers that you tie it to, you want to have a robust enough system that you can retrieve those records for if you receive a notification from one of those agencies, that you can actually pull up all of the relevant documents that are needed and not have to go shopping through different file folders and different filing cabinets in some cases to obtain those records. And lastly, you want to make sure that there is a final approval process in place where if everything checks out, you can proceed with the transaction. There is a clear green light on what was done. This is sufficient. We are in the clear. Go ahead and make the transaction happen. But if there are still any suspicious indicators, go back to that additional information step and get that information and screen it or vet it before you proceed with the transaction. Know when to say go ahead and know when to say not yet. In many cases, I'm going to flip back for a second. In many cases, learning that you need more information, or even learning that a party is on one of those lists, does not automatically prevent the transaction from happening. It's an indication that you need to get additional approvals before you can go ahead with the transaction. You cannot conduct that business without notifying the agencies involved and obtaining one of those licenses. And those links earlier on the slides will help you obtain one of those licenses so that you can proceed with those transactions if it's right for your business to do so. If a violation does occur, you can use a process called voluntary self-disclosure, VSD. This is the act of disclosing to the federal agencies that a violation has occurred. This is what happened. This is the extent of it. And this is what's being done to protect it. Voluntary self-disclosures, unlike prior disclosures are on the import side. If there's a violation when importing goods into the US, you can issue a prior disclosure to Customs and Border Protection, and it will protect you from penalties. On the export side, VSDs do not necessarily prevent the imposition of penalties. There is no penalty protection in the case of voluntary self-disclosures. But voluntary self-disclosures do reduce or prevent future violations, both by recognizing what went wrong, how it went wrong, and instituting the proper controls to prevent it, as well as ensure that there is enough cultural awareness within your organization now going forward that these violations can occur and will occur. The VSDs do reduce and prevent reputation damage. They prevent things from escalating beyond out of control, and they often keep you from being splashed on the front page of the newspapers if there is proper protections put in place going forward. And the VSDs can serve as a mitigating factor, and this is extremely common. When there is a VSD, penalty amounts will be reduced and or suspended based on the circumstances of the violation, based on the circumstances of the disclosure, based on circumstances of the controls being put in place going forward. If you need guidance on voluntary self-disclosures, here's a couple of citations at the bottom of this slide to get you started. They are involved processes, and I would definitely recommend involving an expert or legal guidance before trying to navigate these solo. But if you do find a violation, your only recourse from that point forward is a voluntary self-disclosure. Okay, we're going to tackle some additional info that I want you guys to have before we hop into questions. So the OFAC 50% rule. This is one of the cases where it's important to recognize that a violation can occur even if you searched and screened an entity and they passed that screening test, you had no hits or no viable hits. Because of the 50% rule, there are additional factors that can be relevant to whether or not you're in compliance with these regulations and not being aware of what the you're not exposed to necessarily all of the factors in the transactions. This is where red flags and warning indicators really help to contribute to recognizing when you need to dig deeper. So the 50% rule states that any entity owned in the aggregate, directly or indirectly, 50% or more by a blocked person is itself considered a blocked person. So even if the company that you're selling to or that you've done your screening on is not a blocked person, if they are 50% or more owned by a blocked person, then that entity is also blocked. All property and interests are considered blocked regardless of whether the entity itself is listed. So this is a big caveat that no screening solution is going to be thorough enough to catch all of these factors. You have to recognize those red flags and those warning indicators and use those as your guidepost for digging deeper and getting additional information so that you can be satisfied that you have not violated those prohibitions. Again, the standard is do not export these things to these parties, or do not allow this end use to be done with these goods. It's a do not. It's not a do this kind of an order. They don't say do your screening, you're good. They say if you sell to or transact with a denied party, you're in trouble. There are also scenarios of violations occurring from things like mergers and acquisitions. There was a company in Cleveland, Ohio. In May 2005, a company in Orange, California, exported a machine to Spain. The machine was classified under ECCN 1B001, controlled for missile technology, and the company did not obtain the necessary license. This was in 2005. 6 years later, in 2011, C.A. Litzler Company of Cleveland, Ohio, acquired a substantial portion of that company's assets. And in June of 2013, the BIS amended their charge to include C.A. Litzler as an interested party. And that was granted, that amendment. And C.A. Litzler had to pay $45,000 civil penalty for a transaction that occurred 6 years before they purchased the company's assets and were found to be partially responsible for the violations that occurred. This other company was still in business. They just purchased some of the assets, a substantial portion of their assets. But the company in Cleveland, Ohio was found to be sharing in that violation. And there's a deemed export example. This one is occurring in Santa Clara, California. A company called Intevac released technology subject to the EAR to a Russian national working at its Santa Clara, California facility. So this was a Russian national that was employed by this company from January to August, working at their facility here in the US. And the company shared drawings and blueprints for parts, identification numbers for parts, development and production technology, all of which was classified as ECCN 3E001, and they did not obtain the necessary license to share this information with a Russian national. Intevac voluntarily disclosed the violations and cooperated fully with the investigation. But during the course of, and in the subsequent months following August 2007, after the disclosure was made, Intevac continued to violate the orders by allowing this person to have access to this information. And they were found to be in violation of the orders and had to pay $150,000 civil penalty for those violations. So they even had the voluntary disclosure, but their continued violations beyond their actual disclosure contributed to an increased penalty. So again, this is one example where in the mergers and acquisitions world, a lot of companies don't necessarily perform the full due diligence on trade compliance matters, and I'm talking the legal version of due diligence here when acquiring a business, a lot of times companies need to integrate a review of what sort of transaction history is in place, conduct restricted party screening on customer lists and supplier lists and financial lists prior to the acquisition going through, so that you know exactly what you're buying. And in the latter example, individuals working at your business having access to controlled information could be a violation of the orders. Recognizing how these things can happen and sharing these examples can help you understand, institute the correct controls for your organization. Software limitations. System constraints can prevent the capture of essential information. I did a webinar, I think a year ago, 2 years ago, on software and its pros and cons. And it's nowhere more true than with restricted party screening. Trade compliance software will not do anything that cannot be done manually. It's important to understand that all it's doing is simplifying a step that would take a human longer to do. And that's good. But many times it's going to be extremely limited based on what information is given to the system. There's the old adage of garbage in, garbage out. If you put in only a piece of the information, if you've only got one box for the shipped to and one box for the sold to, and there are 40 other people that are involved in this transaction on the communication threads and the emails and whatnot, and you don't screen all those other parties, you only screen on those 2 that are in the system, then you're missing a huge picture of what is actually going on with this transaction. And this is where it can cross the line from a civil penalty to a criminal penalty, because you've all of a sudden got not only a reason to know, but also you were exposed to the information and you did not conduct the necessary steps that are probably part of your procedures to screen your buyers and your customers overseas. Having access to information as part of the nature of your business and not acting on that information is where violations and penalties can escalate. Many screening solutions limit screening to only the buyer destination while ignoring banks, contract signers, correspondents, and other intermediaries. I see a lot of organizations doing bolt-ons to their ERP systems that will conduct screening for them. That's a great addition to the overall process of restricted party screening and prevention of these violations, but they'll only bolt them on to their customer list, or they'll only extract the customer list for the screening purposes and neglect the banks that are paying the money, the people that have signed the contracts. There's examples in one of the publications I'll give you at the end of this of the fact that the agreement was conducted with a set of people and with a company, and none of those people were debarred parties, but the eventual contract was signed by somebody that was a debarred party. And that person that signed that contract was never vetted. They were never input in the system. There's no place in any ERP system that I've ever seen to put name of person who signed contract. So those things can go missed, but you had the ability to know, the reason to know, and the responsibility to take action to prevent those violations. A lot of times people will ignore the intermediaries like warehouses, freight forwarders and distributors, customs brokers, people that are handling the goods, truck drivers, things like that are generally not captured as part of your ERP systems, and your software is not going to be able to recognize those things. You need to instead make sure that you're recognizing the risk that is inherent to your transactions and layer that into the depth that you're going to take, the depth of the steps that you're going to take and what additional information you require, using those red flags and those warning indicators as key markers for understanding how far you're going to go in each scenario, what your standard operating procedure is going to look like, and what your exception operating procedure is going to look like. And it's important to remember that automation is not a substitute for knowledgeable individuals and sound business practices. That's my warning on software. I love software. I think it's great. Just recognizing what it can and can't do is an important piece of having the protections in place that you need to have. So some recommendations, diligence. It's all about making sure that you've done your diligence. Rescreening. This is one of the questions that was posed prior to the webinar. I think the question was along the lines of, what do I recommend as rescreening? And my answer, as with all things in trade compliance, is going to be along the lines of it's going to be based on your risk. If you only have one transaction every 10 years, you don't need to rescreen every year. Your risk profile is not going to be there. If you have 1,000 transactions a week, you probably want to rescreen at least every couple of weeks. Oops, sorry about that. So you want to pay attention to what your business situation is and what circumstances you're facing to control rescreening. My default statement is rescreening at least annually, but based on your volumes or based on the nature of your products, you may want to increase that to semi-annually or quarterly. Monthly can also fit depending on the circumstances. You also want to consider disclosing your non-violating past transactions, and these usually you become aware of these through the rescreening process. You conducted a transaction 3 years ago, this person was on the list, you've rescreened today, and this person is on the list today, but you haven't done business with them in the last 3 years. BIS is recommending, and I think it's a good idea, to consider disclosing the fact that you had a transaction with this party in the past and that you are not currently in business with them. If you are in business with them, you are going to take steps to prevent a violation of the orders, yada, yada. It goes a long ways towards painting your compliance program, internal compliance program, in a positive light for the various agencies. It goes a long ways towards maintaining a culture of awareness within the organization. And it is a generally good idea just to surface any possible offshoots of those transactions that may have actually been violations that were flying under the radar. You want to increase your efforts based on the risk of your business type. You want to communicate with your overseas partners and affiliates. I talked about this a little bit earlier, but the controls are on U.S. goods wherever located, even abroad. Even if they've already been exported, even if they're no longer in your control, you want to make sure that your partners are aware of what they can and cannot do with your goods. And that includes reselling. If you've sold the goods to a company in Germany and that company resells them to Iran, they're in violation of those orders because these are U.S. goods that are located in Germany that have been sold. Whether or not you're in violation in that scenario is usually up for debate. In most cases, not, unless you had reason to know. But you want to make sure that you've communicated and you've done your due diligence on communicating this to your overseas partners. Hey, you may not resell these things in violation of the U.S. export controls and restrictions. Do not assume anyone else in the supply chain has you covered. They do not. I've dealt with many companies that said, "Oh, my forwarder does screening for me." And what they mean by that is they provide an order for pickup to the freight forwarder, and they provide a destination, maybe even provide an SLI to the freight forwarder on the export transaction, and they expect that to be coverage. And the reality is that it's not even close to coverage for reasons I've kind of talked about. But the freight forwarder does not have the red flags and warning indicators that you're going to be exposed to as the exporter. They're not going to have the insight to the transaction, to the nature of your business, to the nature of the buyer's business. They're usually just processing an order. So you want to make sure that you're not trusting third parties unless they've been specifically contracted to interface with your systems and work with your people and are part of your overall solution and not the whole thing. But you do not want to assume that anyone else in the supply chain is protecting you, because they are not. Before we get to the last slide here, I want to say we do provide an evaluation service for companies that want to kind of gauge where they stand in trade compliance. And we have a scorecard that we assemble based on 19 different zones of compliance risk that we evaluate based on your company's business practices, your industry type, what sort of environment you have in place. If you're interested in having that service provided, reach out to us. You can hit us via training@startusa.org is usually the best way, or contact form on the website. Okay, my parting thoughts before we get to questions. There is a regulatory requirement to prevent violations. That's your objective. Now, I recognize that I have probably not solved anyone's problems here today, but that wasn't my goal from the outset. What I was setting out to do was try and raise the awareness bar of what violations count and how they are accumulated, or what sort of vectors are in play, and what sort of building blocks you need to pull from to create your own solution. Methods and practices vary widely. Each method has its limits. Knowing those limits allows you to create a solution that helps to minimize the overall limitations of your eventual solution. My goal is to give you those building blocks to create a program that fits your profile and achieves that due diligence. And even if you have those protections in place, violations can happen. It is extremely simple for a violation to occur, particularly if you don't have proper due diligence. But even if you do, those violations can occur. I think the mergers and acquisitions was a great example of how those things can happen, and you can be found liable. Knowing what to do if you would discover a violation is also part of your overall strategy. And you should have action plans for when those things happen, or if those things happen, if you prefer to be optimistic. Knowing who's going to notify which agencies, who's going to be involved in the voluntary disclosure process, how that all comes about is an important piece of your overall strategy. Okay, I am going to hit questions here for the last couple of minutes. I see some have been submitted, and we'll go from there. If I don't get you before you leave, thank you all for attending, and I appreciate everyone's time today. Okay, submitted in the chat by Elizabeth. How would you find details of who owns the company in an international company? That's a good question. It's one I often ask myself frequently. There are resources out there that either, depending on how deep you need to dig, based on the nature of your transaction, you can actually use various indicators like Dun & Bradstreet ratings, various websites that have published ownership information. Google is actually a pretty good resource, or at least a starting point for helping identify certain parameters. And you use all the resources at your disposal. Usually those vectors are going to be financial in nature, and sometimes they can be legal in nature. If you have legal resources in those foreign countries, or access to legal resources in those foreign countries. I don't think that it is a requirement that you conduct an ownership evaluation on every single transaction in all cases. I think it's important to recognize when a particular transaction is suspicious, or is with a particularly controlled technology, or going to a particularly questionable place, that you conduct a more thorough investigation, including trying to find out who the owners are. If you have trouble finding those owners, which in most legitimate transactions should not be that big of a problem, unless it's a small organization that it does not have a major presence, you can find out who the owners are in many cases by applying what I would call elbow grease to those circumstances. It's not a perfect answer. You dig hard to find the owners. I do have a story. I'll tell that story later. I'm going to questions first. All right. During a recent internal audit of our exports, this is asked by Anonymous. During a recent internal audit of our exports, we found evidence that an SLI stated no license required NLR, but in fact, we did have an export license. One was required. It's been 4 years. Should we do a VSD for an SLI? I'm assuming that the goods were exported. Okay, so there was a license obtained, so you're not in violation of the actual order, but the documentation surrounding it was in violation. So you're looking at a VSD of a census nature there. This is not rising to a BIS or ITAR level violation. This is arising to incorrect information on the electronic export information, the EEI. And I would say yes. I would say do a VSD and use that as an opportunity to re-instruct your forwarders, instruct your personnel that are completing these forms internally. But in VSDs with census, and in a scenario where a clerical violation, not an actual substantive violation, the penalty is typically mitigated down to $200 as a first offense. I would certainly consult with legal. You can elect to not disclose these things and just hope you don't get caught. If you do get caught and you are aware that there was a violation and you did not disclose it, that is problematic and can land you in more hot water for basically turning the act of turning the blind eye there. So since you are aware of it, yes, you take the step for the VSD. Okay, pre-submitted questions. Please feel free to submit more questions. I'm going to stop the recording at this point. And everyone's free to hop off. But thank you again for your time.